Stop for a moment and pay attention, because something extremely unusual is happening in the global silver market right now. Today, the data coming out of the COMEX exchange is raising serious questions across the financial world. At first glance, it might look like just another routine delivery report, but when you look deeper into the numbers, the scale of what is happening becomes difficult to ignore. In a single session, more than 500 silver contracts were demanded for physical delivery. Not cash settlement, not paper rollover, but actual metal. That means real silver bars leaving vaults. And when analysts started looking at who was requesting those deliveries, the situation suddenly became much more interesting. Some of the largest financial institutions in the United States appeared directly in the delivery data. Bank of America Securities stepped forward and demanded more than 200 contracts for physical metal. JP Morgan Securities added dozens more. When institutions of this size begin taking delivery of silver, it sends a signal to the rest of the market. These are not retail investors reacting emotionally to headlines. These are banks with access to deep research, global supply networks, and teams of analysts studying the metals market every day. When they move into physical assets, it usually reflects a longer-term strategic calculation rather than a short-term trade. To understand why this matters, you have to look at the bigger number behind the headlines. The total quantity of silver standing for delivery this month has climbed to more than 6,000 contracts. Each contract represents 5,000 ounces of silver. When those numbers are multiplied together, the result is staggering. More than 32 million ounces of physical silver are now scheduled to leave COMEX vaults through the delivery process. That metal will be packaged, transported, and moved into private ownership. And here is the detail that makes the situation even more important. The delivery window is still open. More contracts can still stand for delivery before the process ends. In other words, the outflow could grow even larger. For years, the silver market has operated under a system where paper contracts dominate trading activity. Futures contracts change hands constantly, sometimes representing hundreds of millions of ounces in theoretical supply, but the physical metal stored in exchange vaults is far smaller than the volume of paper claims circulating through the market. That imbalance has been discussed by analysts for a long time. As long as traders are comfortable settling contracts with cash rather than demanding delivery, the system continues functioning smoothly. But the moment large participants start requesting the metal itself, the dynamics of the market begin to change. What we are seeing now may be the early stages of that shift. COMEX has traditionally served as one of the main centers for silver price discovery in the Western financial system. The futures contracts traded there influence global pricing benchmarks used by manufacturers, traders, and investors around the world. But if physical inventories begin declining at the same time delivery requests increase, pressure can begin building beneath the surface of the market. Recent inventory trends suggest that this pressure may already be forming. Over the past year, silver inventories held inside COMEX vaults have reportedly declined by roughly 34%. That means a significant portion of the metal that once backed the futures market has already been withdrawn. Meanwhile, similar patterns are emerging in other major exchanges around the world. The Shanghai Gold Exchange has experienced a dramatic drop in available silver inventory. The SHFE exchange has also seen large reductions in metal stored within its system. When multiple exchanges experience declining inventories at the same time, it usually reflects growing global demand for physical metal. Silver is being pulled out of vaults and absorbed into industrial supply chains, private investment holdings, and strategic reserves. And the timing of this trend is particularly interesting. The world today is entering a period of rising geopolitical tension. Governments across multiple regions are increasing defense budgets and investing heavily in advanced technology. Global military spending has climbed to record levels, reaching more than $2 trillion annually. Modern defense systems rely heavily on electronics, sensors, and communication equipment. Many of those systems require silver because of its unmatched electrical conductivity and reliability. From precision guidance components to satellite communication systems, silver plays an important role in the infrastructure of modern technology. Unlike consumer products, where manufacturers constantly search for cheaper alternatives, defense systems prioritize performance and reliability above all else. When a material provides superior electrical performance, engineers use it regardless of price. This creates a unique form of demand within the metals market. Military demand for critical materials is often less sensitive to price fluctuations than other types of consumption. When governments are building advanced equipment, the priority is ensuring functionality rather than minimizing raw material costs. That means demand for certain metals can remain stable or even increase during periods of geopolitical tension. Silver is one of those metals. At the same time, civilian industries are also expanding their consumption of silver at a remarkable pace. Renewable energy technology is one of the fastest growing sectors of the global economy. Solar panels rely on small amounts of silver within their conductive layers to efficiently collect and transfer electricity generated by sunlight. As countries invest billions into renewable infrastructure, millions of new solar panels are being installed every year. Each panel contains only a small quantity of silver, but when installations reach industrial scale, the total demand becomes enormous. Energy storage systems are another rapidly expanding sector. Modern electrical grids increasingly rely on battery storage facilities to stabilize power supply and manage fluctuations in renewable energy production. These systems incorporate complex electronics and connectors that often rely on silver for reliable electrical performance. Analysts tracking the growth of battery energy storage expect capacity additions to increase dramatically over the coming years. As those systems expand, the metals required to build them become increasingly important. All of these trends point toward the same underlying reality. Silver is no longer just a precious metal used for jewelry or investment. It has become a critical industrial material embedded deeply within modern technology. From renewable energy to advanced electronics to strategic defense infrastructure, silver sites quietly inside many of the systems that power the modern world. And yet, despite this expanding demand, the price of silver has experienced extreme volatility recently. Not long ago, the metal surged dramatically, climbing to an intraday high above $120 during a powerful rally. That move captured attention across financial markets, but the rally did not last. Shortly afterward, the price collapsed sharply, falling toward the mid-$60 range in a matter of weeks. The decline represented nearly a 45% drop from the peak. For many investors, that sudden correction created confusion and panic. Some believed the rally had ended, and that the market was reversing into a long-term downtrend. Others assumed the previous surge had been nothing more than a speculative bubble. But some analysts interpreted the move very differently. Peter Craw, author of The Great Silver Bull and a well-known voice in the precious metals community, described the decline as something that frequently occurs during strong bull markets. According to his view, the sharp drop represented a classic bear trap designed to shake weaker investors out of their positions. In volatile markets like silver, sudden price movements can trigger emotional reactions that cause investors to sell at precisely the wrong moment. When those sales occur, stronger market participants often step in and accumulate positions at lower prices. If that interpretation is correct, the drop from above $120 down towards $67 may have served as a redistribution phase within the market. Investors who panicked during the decline transferred their holdings to larger institutions willing to buy during the chaos. And now something interesting is happening. Silver has recovered from that low and is once again trading around the mid-$80 range. Meanwhile, large financial institutions are openly appearing in physical delivery reports. When price volatility, institutional accumulation, and tightening inventories all occur at the same time, analysts begin asking a very important question. Is the silver market quietly preparing for a much larger move? But the story unfolding in the silver market does not stop with vault withdrawals and institutional accumulation. There is another layer developing quietly in the background, and it could reshape how silver is priced around the world. For decades, the Western financial system has controlled the main mechanisms used to determine the price of silver. Exchanges in New York and London have dominated price discovery, setting benchmarks that influence contracts, industrial supply chains, and investment markets across the globe. Manufacturers in Asia, investors in Europe, and traders in North America have all relied on these benchmarks to determine the daily value of the metal. But today, that long-standing structure may be beginning to shift. One of the clearest signals of this change is emerging from India. India is one of the largest consumers of silver anywhere on the planet. The metal plays a significant role in jewelry, traditional savings, electronics, and industrial manufacturing across the country. Recently, India's financial regulators introduced a policy that could gradually reduce the influence of Western pricing systems. The Securities and Exchange Board of India has directed that physical silver holdings and silver exchange-traded funds should be valued using domestic spot prices, rather than relying entirely on benchmarks from London. At first glance, this might sound like a technical regulatory adjustment, but the implications could be far-reaching. When a major global consumer of silver begins establishing its own price references, it suggests a growing desire to rely less on Western market structures. In effect, India is signaling that it wants greater influence over how silver is valued within its own financial ecosystem. The shift does not stop there. The Reserve Bank of India has also begun integrating silver more deeply into the country's financial system by allowing banks to provide loans using silver ornaments and coins as collateral. This policy effectively treats silver as a recognized financial asset rather than simply a commodity used in manufacturing or jewelry. In many regions, gold has long played this role as collateral for lending, but silver historically received far less institutional recognition. Bringing it into formal banking operations changes how households and businesses view the metal. When a country with more than 1 billion people begins expanding financial infrastructure around silver, the long-term demand implications can become significant. Millions of households already hold silver in various forms, and policies that allow it to support credit could encourage even greater accumulation. While these financial changes are developing in Asia, another powerful force is shaping the demand outlook for silver. Across the world, governments are increasing defense spending and investing heavily in advanced technologies. Global military expenditures have climbed to historic levels, surpassing $2.5 trillion annually. Rising geopolitical tension in multiple regions has accelerated the race for modern defense systems, advanced communication technologies, and next-generation electronics. These technologies depend heavily on reliable electrical conductivity and precision electronic components. Silver possesses properties that make it extremely valuable in these applications. It conducts electricity better than any other metal, which allows signals to move efficiently through complex electronic circuits. In environments where reliability is critical, engineers often choose silver because even minor failures can cause major operational problems. Consider advanced missile systems, radar equipment, satellite communications, and high-performance computing used for defense applications. Many of these systems incorporate silver in connectors, circuit pathways, and sensitive components. Unlike consumer electronics manufacturers who constantly search for cheaper alternatives, defense contractors rarely compromise on performance. If a material provides the best conductivity and stability, it will be used regardless of cost. This type of demand behaves differently from traditional industrial consumption. When a nation decides to produce advanced defense equipment, the decision is driven by strategic priorities rather than short-term commodity prices. Even if the cost of silver rises, production of critical systems continues. In economic terms, this type of demand is relatively inelastic, and that demand is increasing. At the same time, the world is entering a major transition in energy infrastructure. Renewable energy projects are expanding rapidly as governments attempt to diversify power sources and reduce dependence on traditional fuels. Solar energy installations have become one of the fastest growing segments of the global energy market. Each solar panel requires small amounts of silver within its conductive layers. These layers help capture electricity generated by sunlight and transfer it efficiently into the power grid. Individually, the amount of silver used in each panel may appear small, but when millions of panels are installed across large solar farms, the total consumption becomes substantial. As countries continue investing in renewable infrastructure, this demand for silver could grow significantly over time. Energy storage systems are also expanding quickly. Modern power grids increasingly rely on battery storage facilities to stabilize energy supply and manage fluctuations in renewable production. These facilities contain complex electrical networks and electronic control systems where silver is often used for reliable conductivity. Analysts tracking the growth of battery storage technology expect global capacity additions to increase dramatically over the coming years. All of these developments are occurring while physical inventories of silver appear to be declining in major exchanges. When rising industrial demand meets shrinking inventories, it creates a situation that analysts watch very closely. But there is another factor that has started attracting attention among market observers. Strategic supply routes for commodities have become increasingly important in a world facing geopolitical uncertainty. One of the most discussed locations in global energy and shipping networks is the Strait of Hormuz. This narrow waterway connects the Persian Gulf with international shipping lanes and serves as a critical passage for energy resources and global trade. Whenever tensions rise in this region, financial markets begin evaluating the potential impact on supply chains. Silver itself is not primarily transported through the Strait of Hormuz, but disruptions to global shipping or energy markets can influence industrial production and financial behavior worldwide. During periods of geopolitical tension, investors often turn their attention toward tangible assets such as precious metals. These assets are sometimes viewed as a hedge against instability in financial systems or supply networks. That shift in sentiment can influence investment demand for metals like silver. Meanwhile, something interesting is happening within the mining sector itself. For many years, silver mining companies were largely ignored by mainstream investors. Capital flowed into technology stocks, digital assets, and other rapidly growing industries, while precious metals received relatively little attention. As a result, many mining projects remained undervalued, despite containing significant reserves of silver. But recently, that dynamic appears to be changing. Industry observers report that large institutional investors are beginning to send full teams of analysts and geologists to mining conferences in order to evaluate potential investments. Instead of sending a single researcher to gather basic information, investment firms are now dispatching entire groups to study exploration projects, production plans, and development pipelines. This shift suggests that large pools of capital may be preparing to allocate substantial resources to the sector. The economics of silver mining make this development particularly interesting. When silver prices rise, the cost of producing each ounce does not increase at the same pace. Mining companies already carry many of their operating costs in equipment, labor, and infrastructure. As a result, higher metal prices often translate directly into higher profit margins. Some analysts estimate that current profit margins for certain producers are approaching extremely high levels compared with historical averages. Yet despite these improving economics, many mining stocks are still valued by the broader market as if silver were trading much lower than it actually is. Developers, companies working to build the mines of the future, appear especially undervalued. In some cases, their market valuations represent only a small fraction of the estimated value of their silver deposits. For long-term investors studying the sector, this disconnect between resource value and market valuation creates an interesting opportunity. Because if the demand trends currently forming in the silver market continue, those resources could become increasingly important in the years ahead. And that brings the story back to the central question facing the silver market today. If inventories continue declining, if industrial demand keeps expanding, and if institutions continue accumulating physical metal, then the balance between supply and demand could eventually reach a tipping point. And when that moment arrives, the market may be forced to reprice silver in a way that reflects the true scarcity of the metal. When all of these developments are placed side by side, the situation unfolding in the silver market begins to look far more significant than a normal fluctuation in commodity prices. On one side of the equation, physical inventories inside major exchanges are declining. Millions of ounces are leaving vaults through the delivery process. Large institutions are appearing directly in the delivery data. On the other side of the equation, global demand for silver is expanding across multiple sectors at the same time. Renewable energy technologies require it. Advanced electronics depend on it. Defense systems rely on it. Financial institutions are increasingly accumulating it. When both sides of the equation begin moving in opposite directions, tightening supply and rising demand, the result can eventually reshape the entire market. Yet despite all of these pressures building beneath the surface, the price of silver today still sits far below the levels reached during its recent surge. Not long ago, the metal pushed above $120 during a powerful rally that captured attention across financial markets. That move suggested momentum was accelerating, but the market did not continue climbing. Instead, the price reversed sharply, falling all the way down toward the mid-$60 range before stabilizing again near the 80s. To many observers, the volatility appeared confusing and unpredictable. However, for analysts focused on the mechanics of commodity markets, those kinds of dramatic swings are not unusual in silver. Historically, silver has been one of the most volatile precious metals. Rapid price surges are often followed by equally dramatic corrections. These movements frequently shake out investors who entered the market late or who were relying heavily on leverage. And that brings us to an important point about how the silver market actually functions. Most trading in silver does not involve physical metal at all. Instead, it takes place through futures contracts and derivatives. These financial instruments allow traders to speculate on price movements or hedge industrial demand without physically transporting silver bars. The system works efficiently because it provides liquidity and flexibility for large market participants. But the system also creates an unusual dynamic. The number of paper contracts representing silver can grow far larger than the amount of physical metal actually stored in vaults. As long as traders are satisfied settling those contracts financially, this imbalance remains largely invisible. The paper market operates smoothly, and prices move based on trading activity rather than physical supply constraints. However, if a growing number of market participants begin requesting physical delivery instead of cash settlement, the underlying balance between paper claims and physical metal becomes much more important. This is the point that several analysts have been discussing recently. Peter Craw explained that the true stress test for the silver futures market would occur if a large contract holder insisted on taking delivery and the exchange could not provide the metal. In such a situation, the exchange might attempt to offer cash settlement instead. But if the contract holder refused the cash and demanded the physical silver itself, the system could face a significant challenge. At that moment, the market would have to confront a simple reality. Paper contracts represent promises. Physical metal represents actual supply. And when demand for real metal exceeds the available supply, prices must adjust to bring the two back into balance. Right now, the market has not reached that breaking point. Exchanges still hold significant quantities of silver in their vault systems. Delivery requests are being fulfilled, the system continues functioning. But the trajectory of recent data has attracted attention because inventories have been trending downward while delivery demand increases. If that pattern continues, the conversation around silver could shift dramatically in the coming years. At the same time, global economic conditions are adding another layer of complexity to the outlook. Many governments are increasing spending on infrastructure, energy systems, and technological development. Renewable energy installations continue expanding as countries invest in solar power and energy storage. These systems require large quantities of materials capable of carrying electrical current efficiently, and silver plays a unique role in that process. Meanwhile, geopolitical tensions have encouraged governments to strengthen domestic manufacturing capabilities for strategic technologies. Semiconductor production, defense electronics, communication systems, and advanced sensors all require highly conductive materials. Silver remains one of the most effective metals for those applications. As a result, silver is becoming increasingly embedded in the technologies shaping the modern world. When analysts examine this combination of factors, tightening inventories, expanding industrial demand, and growing financial interest, they begin asking a crucial question: what happens if these trends continue? If physical demand keeps rising while available supply tightens, the market may eventually be forced to reassess the value of silver relative to other commodities and financial assets. Such adjustments can occur slowly as investors gradually change their expectations, but they can also occur suddenly if a triggering event forces the market to recognize the imbalance all at once. For traders and investors, this environment creates both opportunity and risk. Silver's volatility means prices can move quickly in either direction. Large swings often occur within short periods of time, catching participants off guard. Investors who rely heavily on leverage may find themselves forced out of positions during sudden corrections, even if their long-term outlook proves correct. Because of this, many experienced participants approach silver with a longer time horizon. Instead of attempting to predict every short-term movement, they focus on broader trends in supply, demand, and industrial consumption. Their strategy centers on the idea that structural changes in the market eventually influence price behavior over time. For those watching the charts, several levels are worth paying attention to. On the upside, the region between $90 and $93 represents an important resistance zone. This area previously acted as a ceiling during recent price consolidation. If silver were to break decisively above that range with strong momentum, it could open the path toward the psychological milestone of $100. Reaching triple digits would likely attract widespread attention from financial media and retail investors who may not currently be focused on the metal. On the downside, the region around $72 has emerged as an important support level following the earlier correction. During the previous decline, buyers stepped in aggressively when prices approached that zone. If silver were to fall below that support in the future, analysts would need to reconsider the short-term outlook and evaluate whether a deeper correction might develop before the next upward move. At the moment, the market remains positioned between those levels. Prices are consolidating while investors watch incoming data about inventories, industrial demand, and physical deliveries. In many commodity markets, consolidation phases occur before major directional moves. During these periods, the market absorbs information and redistributes positions among participants. Once that process is complete, prices often move quickly in whichever direction the balance of supply and demand dictates. For the silver market, the key variables to watch remain the same. How quickly are inventories declining? How much physical metal is being requested through the delivery process? How rapidly is industrial demand expanding across sectors like renewable energy, electronics, and advanced manufacturing? And perhaps most importantly, how are large financial institutions positioning themselves in response to these developments? Because when institutions begin accumulating physical assets rather than simply trading paper contracts, it often signals that they see long-term value beyond short-term price fluctuations. For now, the silver market sits at an interesting crossroads. The physical fundamentals appear increasingly tight. Industrial demand continues expanding. Global economic uncertainty encourages investors to examine tangible assets more closely, and institutions are showing renewed interest in a sector that was largely ignored for many years. Whether these forces lead to a gradual revaluation or a sudden price surge remains uncertain. Markets rarely move in straight lines, and silver has a long history of surprising both bulls and bears. But one thing is becoming clear: the silver market today is not the same market that existed a decade ago. The metal that once played a quiet role in jewelry and investment portfolios is now deeply connected to the technologies and infrastructure shaping the modern world. And if the current trends continue, the next major move in silver could arrive faster than most people expect.